What's up guys, Omkar here for Simple Snippets. In this second tutorial, we are going to look what is an account, types of accounts, 3 golden rules of accounting and double entry system of accounting. So here we begin. First of all, what is an account? Account is a group of all the records of financial expenses, receipts or events. So let's look at what are the types of accounts. Classifying broadly, there are 2 types of accounts. First is personal account and another is impersonal account. So what is personal account? Personal account is account which belongs to individual, group of persons, that is group of individuals, any legal body, artificial person, that is government, various other authorities, etc. Second is impersonal account. Impersonal account can further be classified into 2 subparts. The first of it is known as real account and another is nominal account. Real account is an account which is an asset for a company. There are further 2 types of real accounts. First is tangible real and another intangible real. Tangible real account contains all those things which can be seen and touched by a person. For example, building, plant and machinery, furniture, etc. Intangible real accounts contains all those things which cannot be seen but those are assets to a company. Examples of which are goodwill, patent, trademarks. So basically, question comes to mind, real account are assets and assets are building, plant and machinery, furniture, patent, trademarks and all that. So what is asset? Asset is anything which has economic benefit to the company. Anything which is having economic benefit to the company or anything which can generate cash, revenue or any other benefit in any kind to a company is an asset to a company. Further, nominal account. Nominal account contains all expenses and losses, all incomes and gains. So why this is necessary to learn what are the types of accounts? Because after identifying a transaction while recording the same into the books of accounts, we should know what type of account it is and on the basis of which when golden rule is applied to a transaction, we can accurately record the transaction into the books of accounts. Going further, 3 golden rules of accounting. We have seen there are major 3 types of accounts and hence there are 3 rules of accounting based on these 3 types of accounts. First rule is for personal account, second rule is for real account and the third rule is for nominal account. Rule of personal account says debit the receiver, credit the giver. We are going to discuss in detail what is debit and credit in further part of this tutorial, but right now we are concentrating only on the golden rules of accounting. So rule of personal account says debit the receiver, credit the giver. For example, if company has paid money to A, then A is the receiver of money, A's account will be debited and vice versa. The rule of real account says debit what comes in, credit what goes out. For example, if plant and machinery is purchased by a company, then plant which is an asset to company will be debited because the plant and machinery is coming into the business. And similarly, if company has sold some furniture, then furniture is going out of the business while accounting transaction of furniture sold, furniture will be credited. So this is rule of real account. Rule of nominal account says debit all expenses and losses, credit all incomes and gains. For example, rent is paid by the company to landlord. Here, rent is an expense for the company, so rent account will be debited. Taking another example, if company has invested some money in shares and dividend is received by the company, then dividend received is an income. Dividend received account will be credited by the company in books of accounts. If company purchase machinery for cash, machinery is coming into the business, so machinery is real account, and rule of real account says debit what comes in, machinery will be debited, and cash is going out of the business, hence cash is also a real account. In this case, cash account will be credited. If company has sold goods to Mr. A, the accounting entry will be Mr. A debit, because Mr. A is personal account, he is an individual, he is receiver of the goods, so debit the receiver, Mr. A, and credit goods is going out of the business, hence goods account will be credited, which is real account. So here we have applied the rule debit the receiver and credit what goes out. So this is not necessary that these three golden rules will come as it is while recording a transaction, but the rules will prevail in combination whenever a transaction comes. So it varies according to the transaction. Now proceeding further, debit and credit. In above rules, we have seen the debit and credit. But what is significance of this debit and credit? In case of double entry bookkeeping system, each transaction has two effects. We have seen in above example of goods sold to Mr. A that transaction was having two effects. We have debited Mr. A's account and goods were going out of the business, so we have credited goods account or sales account, you can say. Similarly, each and every transaction has two effects. And there is one interesting fact that when transaction is recorded based on above rules, it will have debit and credit effect in equal force when aggregated. This debit and credit should not be taken as favorable or unfavorable, but they are just two sides of accounts. These three golden rules and the concept of debit and credit will get more simpler in our next tutorial, visit journal. So stay tuned. See you in next tutorial. Thanks for watching, guys.